some investors will continue to pay attention to US President Trump's foreign and domestic policy plans. Others will be combing through the results of the German elections on the 23rd, and in between all of that, we're now really motoring when it comes to the UK's reporting season. More than a dozen FTSE100 firms and a good number of mid and small caps besides are scheduled to release year-end or half-year results in the coming week, and they include Unite on Tuesday the 25th, Hikma and Convatec on the 26th, Rolls-Royce, Aviva, London Stock Exchange, Haley and Hiscox and Taylor Wimpey on the 27th, and Pearson, IMI, Rightmove and Endeavour Mining on Friday the 28th. Besides that esteemed list though, we also have an interesting juxtaposition, as we're due to see full year results for 2024 from both the best and the worst performers in the FTSE100 in the coming week. The best is International Consolidated Airlines, AAG, due on the 28th, and the worst is Croda, due on Tuesday the 25th, which is also when another serial laggard, Smith Nephew, will report. 5 years on from COVID-19, and shares in International Consolidated Airlines are the parent of BA, Iberia, Aer Lingus Vueling and Level are flying high again, as they've more than doubled in the past year. Strong demand for travel, softer oil prices, good cost control have all helped to buoy earnings, help IAG return to the dividend list, and launch its first share buyback since 2018. In the third quarter, sales rose 8% and operating profit by 15% year on year, as British Airways in particular showed a strong improvement in profit. For the whole year, analysts expect sales to rise 8% to €31.7 billion and adjusted operating profit to increase 15% to €4.1 billion. If Chief Executive Luis Gallego provides any guidance for 2025, the current consensus forecasts are looking for growth in sales of 4% and profits of 11% to €33 billion and €4.5 billion respectively. Mr. Gallego isn't likely to be that specific so early in the year, so analysts and investors may have to piece together their estimates from any steer on key profit drivers such as capacity growth, forecast to be 6% in 2024, but at the mercy of supply bottlenecks at Boeing and Airbus, as Ryanair has already complained. Load factor, 89.9% in the third quarter. Pricing, where average revenue per seat kilometre, or ASK, rose 1.2% year on year in Q3, and costs, where non-fuel rose 2% and fuel fell 4% in Q3, and IAG's hedged, by the way, all the way up to around 48% through to the end of this year. Now, profits and cash flow will then help to shape capital returns to shareholders. IAG declared an interim dividend of 3€ a share, its first payment since the first half of 2019, and analysts have penciled at €0.0784 for the whole year, while the firm's also launched a €350 million buyback. Now, if AIG shares are flying high, then Croda's are down in the dumps, after a fall of more than a third in the past year and 2/3 since late 2021. Part of that's down to how higher interest rates have persuaded investors to pay lower multiples for perceived secular growth stocks. Croda has derated from a prospective price earnings or PE multiple from around 40 times to barely 20, though that's still a premium to the FTSE100. Part of it's also down to earnings disappointment after a series of profit warnings, so both the price multiple or P and earnings estimates or E in the PE calculation have gone down. The key to this full year report will be whether Croda can meet guidance of an adjusted pre-tax profit of between £260 and £280 million for 2024. That's down from £309 million last year. And any guidance, if any, Chief Executive Steve Foots feels able to give for 2025, analysts are currently looking for a rebound to £309 million. Also note that Croda is nurturing a dividend growth streak that goes back to 1999. Analysts think this will be maintained just. After a flat first half payment, analysts expect a full year divvy of 110.4p a share compared to 109p in 2023. Finally, Smith Nephew not lived up to the investment thesis it would benefit from a marked rebound in elective surgery post-COVID. Shares in the orthopaedic implant, sports medicine and wound care specialist are down by almost a tenth in the past year and by more than 40% in the past 5. Chief Executive Deepak Nath's turnaround plan is yet to galvanise financial and operational performance or the share price, and both he and the company need to impress, especially with activist investor Shavian on their tail. Smith Nephew coughed up a profit warning at the third quarter stage, so the 2024 numbers shouldn't really feature anything much new, barring a refreshed divisional reporting structure. Analysts already expect low to mid-single digit percentage underlying sales growth, a modest increase in the underlying operating margin, and a broadly flat earnings per share figure. The key may be any steer for 2025 from Mr. Nath, where analysts currently expect mid-single digit percentage revenue growth and margins towards the lower end of the guided 19 to 20% range. Hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.